Good morning, everyone. This is Peter Hang from Wespath Benefits and Investments. I want to thank you for joining us for this webcast. We want to say congratulations on your upcoming retirement, and just thank you for being here. So we have about 60 or 62 minutes of content we want to share with you, and a couple disclaimers. We will not be covering health insurance as well as Social Security. So if you have questions on those issues, you should ask for your health insurance, definitely your conference benefit officer or your annual conference. And with Social Security, we're going to talk about EY, Ernst & Young, which is an option to get more information on that. But we're going to focus on the retirement plans at Wespath, as well as the different services. I want to just introduce my colleagues. So Bob Christoffel is the manager of the Benefit Educator Department.
Good morning.
Todd Creviston and Ronald Theodore.
Good morning.
I was a benefit educator for 12 years and recently moved on to a new role, so I'm going to be running kind of the technical side of this morning's webcast. So as I mentioned a little bit earlier, we have about 40 people expected on this webcast. So we are going to mute the lines to just minimize any distractions, background noise. But please take advantage of the chat section. If you have any questions, feel free to send them to me, Peter Hang, and I will get right back to you. If it's a question in which the answer would be beneficial for everyone to hear, I'll share that with the group for them to speak on and wax eloquently on. So with that, I want to, you saw our live photos, but we had, just in case the video didn't work, there are our official mug shots, if you will. And, but again, we're glad that you're here this morning. Hopefully this will be a very helpful 60 minutes. And some of you might have already attended a retirement seminar of your annual conference. This is going to be very similar, albeit condensed for the hour. But at this point, I'm going to turn it over to my colleague Ronald, and he's going to begin the session.
Thank you, Peter. Good morning, everyone. As Peter stated, I am Ronald Theodore. I am one of the benefit educators here with Wespath. And today I'll be going over the webcast overview. We're going to start the seminar off with the 2019 retirement process. And then we'll switch gears and talk about the Wespath retirement plans, where I myself will discuss the Clergy Retirement Security Program. Then I'm going to hand it off to Bob, who's going to cover our ministerial pension plan as well as pre-82 plans. Once Bob has finished doing the MPP and the pre-82, he will hand it off to Todd Creviston, who will talk about the United Methodist Personal Investment Plan, or the UMPIP. Once we've covered all the Wespath retirement plans, we're going to switch gears and talk about some different services that Wespath has to offer. We'll start with the Life Stage suite of services, which you'll have two options to where you have the Life Stage retirement income as well as the Life Stage investment management. We'll discuss those in detail. Then we'll talk about how in retirement you have the access to utilize the housing allowance exclusion as a retired clergy. Then we'll switch gears and talk about the comprehensive protection plan, the death and disability plan. And then after that, that's when it really gets fun. We talk about the benefits processing. That will discuss when you get your money and how you would get your money. Then we'll finish off with the benefits access review. So for the 2019 retirement process, all benefit applications will need to be completed in Benefits Access. If you have not already registered for the website, that would be a homework assignment for you to do effective today. You will need to register for Benefits Access by logging on to benefitsaccess.org. And once you've registered, you will be able to begin your retirement registration process. Please keep in mind, you will need to indicate your retirement choices no later than June 28th, 2019 at 3 p.m. But I would not wait until that date. The earlier you have this process completed, the better. Again, I want to make notice to the 800 retirement team phone number at the bottom. This is the phone number to the retirement team who are specialized to assist current year retirees on their retirement process. And again, as I stated, once you've registered for benefits access, when you log on, this is the page that you will come to. You will see that green review button. That green review button will allow you to begin setting up your retirement processes. Now we're going to talk about retirement plans. Some of you, most of you, or maybe all of you may have one or all of these plans listed here. So first, I'm going to start with the Clergy Retirement Security Program plan. This Clergy Retirement Security Program has two portions to it, two components. The first will be dealing with the defined benefit for your service from 2007 to 2013. And then we'll talk about the service from 2014 going forward. Once we've completed that component, we will then discuss the defined contribution options. So as I stated, Clergy Retirement Security Program has two components. The first component is a monthly benefit. This is also referred to as the defined benefit, or some of you may also refer this to as an annuity. This is the benefit that will pay you on a monthly basis based on a calculation. Then we will discuss the account balances, which are referred to as the defined contribution. This defined contribution account has the ability, you have the ability to access the funds within this account in the form of either a cash balance, lump sum distribution, partial distribution, or you can choose to set it up as monthly cash installments. And we'll talk about those options in a few moments as well. But first, I'm going to start with the monthly benefit, the defined benefit portion. So for the Clergy Retirement Security Program, the defined benefit portion has two pieces to this benefit. The first deals with your service from 2007 to 2013. This benefit is calculated using the three factors listed below. The first factor is the credited years of service factor that we will use, and then we'll multiply it by the denominational average compensation at the time of retirement. After that, we'll multiply that by the years of credited service. So we'll be taking 2007 up into 2013, and we'll multiply that to get a monthly benefit number. So you're probably wondering, what does that look like? Well, here it is. We're going to take $71,361 multiplied by 0.015 times 7 years. Since benefits are not paid annually, they are paid monthly, we will divide all of that by 12, which will generate a $520 monthly benefit for this service from 2007 to 2013. But wait, that's not it. We have another piece to this puzzle. This is the second portion, the 2014 service and beyond. What that beyond means, for this year, we're going to take your service from 2014 up until 2019. So that's about 5.5 years of service. So we'll do that calculation again, and it will look like this. $71,361 multiplied by 0.01 times 5.5 years equals $3,925. Again, benefits aren't paid annually, they're paid monthly. Divide that by 12, and you have $327 per month. So we have $520 plus $327 per month. That's a total of $847 per month as a monthly benefit from your Clergy Retirement Security Program defined benefit portion. Again, some additional factors you may need to consider: the surviving spouse benefit available on these factors, as well as a choice cost of living adjustment. And for those participants who may be considering early retirement, you may want to consider the reduction for early retirement benefit as well, which looks like this. In this example, I have a participant who is considering retiring at age 63. 63 is considered early retirement, so we would reduce their benefit by 0.5% for each month they have yet to reach the age of 65. So for this participant, they're being reduced 12%. So 847 minus that $102 will give you $745 per month as a monthly benefit for the Clergy Retirement Security Program defined benefit piece. Now, a participant may be asking, well, will I get an increase once I reach the age of 65 since I retired early? The answer to that is no. This early reduction is a permanent reduction of benefit if you choose to begin your benefits earlier than age 65. So for the Clergy Retirement Security Program defined benefit portion, there are some additional considerations you will need to take into account. Again, for your service from 2014, you will need to, 2014 and beyond, you will need to make the election of what type of annuity you would like. For a married individual, all annuities a participant automatically qualifies for a joint life 70% survivorship annuity. If you would like to choose another annuity form, you would have the ability to choose either joint life in 85 or 100% annuity. Again, for your service from January 1, 2014 and after, you will need to make that same election, as well as choose a cost of living adjustment increase as well. All annuity benefits come with a 2% default cost of living increase. You may elect 3, 4, or 5% increase, but please keep in mind with a higher increase, you could, you would consume a lower beginning benefit. So once you've registered for benefits access and you begin to set your benefits up, this is what the actual page will look like. The first portion deals with your service from 2007 to 2013. And this is where you would make the election of the type of annuity you'd like to receive: life in 70, life in 85, or life in 100. Once you've made that decision in the first section, you will need to make a decision for your service beginning 1/1/2014 and beyond in the second section. Once those decisions have been made, please keep in mind there's still another decision to be made, which is the cost of living adjustment at the bottom. So once all of those decisions have been made, you will have completed the annuity election for this defined benefit, for this Clergy Retirement Security Program defined benefit, monthly annuity benefit. Now let's talk about the defined contribution account balance. This defined contribution account balance is made up of a 2% non-match contribution into this plan. If you, the participant, have contributed to the United Methodist Personal Investment Plan a minimum of 1%, then your plan sponsor will have matched 1% back into this Clergy Retirement Security Program defined contribution. So in essence, you would be receiving 3% into this Clergy Retirement Security Program defined contribution. The defined contribution account balance, you have the ability to leave it on account until age 70 and a half if you choose not to begin taking distributions from this. At that point, you would be required to take required minimum distributions. This is invested as directed by you, the participant. So if you choose to self-manage this account or have it managed by Life Stage Investment Management, you would be able to do so. So just to recap, the Clergy Retirement Security Program distribution options are: for the Clergy Retirement Security Program defined benefit, you have the monthly benefit, to which you will make your elections of the type of annuity for a surviving spouse, as well as you will need to make an election for the cost of living increase. And with the Clergy Retirement Security Program defined contribution, you have the choice of either taking a lump sum distribution or a partial, rolling these funds into the United Methodist Personal Investment Plan, or setting up cash installments from the United Methodist Personal Investment Plan, whether it be a life stage retirement income or a self-managed retirement income. Any remaining balances on account would be transferred to a participant's beneficiaries at the time of their passing. Now I'm going to switch gears and hand it over to Bob Christoffel, where he will talk about the ministerial pension plan as well as the pre-82 plan.
Thank you, Ron. Very good explanation of the Clergy Retirement Security Program. And, clergy will have to make some important decisions in the upcoming weeks. I would encourage them to focus on the defined benefit choices because those decisions are so important and not revocable once they are set up on a pension payroll. Defined contribution is just giving them that nice control and flexibility to make changes with that cash account balance. Prior to the Clergy Retirement Security Program, you existed under the Ministerial Pension Plan. And that went from 1982 through the end of 2006. What makes MPP different is that it is a balance that appears on your statement. It has to be managed using life stage investment management. And this remains a separate account balance and is fully invested up until June 30th, the day before benefits will commence if elected. Upon commencement, that balance is split. 65% of it becomes a lifetime annuity, a monthly direct deposit that lasts as long as the participant lives, and if elected at retirement, will continue to the surviving spouse. Important cost of living adjustment decisions also need to be made both for MPP, Ministerial Pension Plan, and the Clergy Retirement Security Program defined benefit. And it's interesting that the decisions made for one plan don't need to be the same for the other plan in terms of surviving spouse, in terms of COLA percent. The other 35% of your MPP balance is not annuitized. That remains a cash account balance with control and with flexibility, different distribution options. It can become a source of monthly income for the retired participant. The annuity, the larger part, the 65%, is based upon exactly what is 65% of that balance on June 30th, if commencing July 1. The remaining 35%, Peter, what I see most often clergy do is they'll just roll that over directly. It's very easy to do on benefit access, directly into UMPIP. And then from UMPIP, you have that control, that flexibility. You can take a full distribution if needed. You want to consider that very carefully from a financial planning and tax planning perspective. You can take partial distributions. You can use a service that we'll talk about in a moment called Life Stage Retirement Income, whereby Wespath will calculate how much we think you can take out on a monthly basis so that your consolidated DC, defined contribution, account balances approximately last your lifetime. So a lot of options there with that 35%. But again, I would encourage you to focus on the tough, irrevocable decisions regarding the larger part, the 65% that is annuitized, plus those real important Clergy Retirement Security Program defined benefit choices. You have important decisions to make. You want to consider this very carefully. You want to discuss this with your spouse or someone you trust financially. If you have an accountant, a financial planner, it would be good to have these conversations. I think it's real important to understand not just the choice you make, but also for the annuities, the 5 choices you are not making. And we'll walk you through those different annuity types, and we'll try to talk about the importance and the impact of the different COLA, cost of living annual adjustments. And those are important to keep up or outpace the rate of inflation. For purposes of this discussion, when we say annuity, we're really just talking about a stream or a series of monthly payments, monthly direct deposits, income coming from various different plans. And that annuity, regardless of which one you choose, will last your lifetime, and if elected, can continue to your surviving spouse or other designated contingent annuitant. The annuity for MPP, that's 65%. We look at different factors, which are very important. Your age is an important consideration. The age of your spouse or other contingent annuity is also important. What exactly is 65% of that account balance? What type of annuity did you select? What about the COLAs? The default COLA for both MPP and Clergy Retirement Security Program defined benefit is 2%, but you'll have other choices, 3%, 4%, 5%. Ron had mentioned that everybody in CRSP will get at least a 2% cost of living adjustment. In addition, for the ministerial pension plan, you also have a 0% COLA option. So we'll look at that in a moment, the impact of choosing a higher COLA or a lower COLA. We also look at your life expectancy. We'll use mortality tables and the Wespath annuity payout rate to calculate this annuity, this monthly benefit that will last your lifetime. On the following two slides, we have an example. This is no one's exact benefit that you're going to receive, but it's an example of a clergy person who is age 65 and the spouse is age 65. So we'll look at three, what's called life and a certain percentage, also called joint and survivor annuities covering 2 lifetimes, and then we'll focus on the next three, the SLAs, the single life annuities. The first three, the joint and survivor annuities, you'll notice on this slide there are 2 columns with dollar amounts. Wespath does not pay out both columns at the same time. The column in the middle, labeled payable to you, is the retired participant. When that retired participant passes away, the amount on the right is payable to the spouse or other contingent annuitant. So if we're looking at this chart, let's look at the highest dollar amount we see here is $1,284, and it's on a row labeled annuity type life and 70%. So the life part is the amount payable to you initially, $1,284 plus whatever cost of living adjustment. Upon your death, the percentage, 70% of that $1,284 would continue if elected to the surviving spouse, 70% representing $899. And you might look at that number and say, well, my wife doesn't have retirement benefits, my spouse doesn't have anything coming, they're still going to have expenses, some things will change when I die. $899 might not be enough. So let me also consider the next one, the life and 85% annuity type. And if you look at it closely, you'll notice 2 things happen. The amount payable to you decreases slightly, but the amount payable to your spouse or other contingent annuitant goes up a bit more. In this example, to $1,053. And you might also think, well, that might not be enough. Let me also consider the life and 100%. And what that means is 100%, or essentially the same amount, continues to your surviving spouse. Initially, that $1,196 plus whatever COLA election was made. So the same amount of income continuing to that survivor contingent annuitant. So those are the joint and survivor annuities, 3 different ones to choose from. The next chart, we're looking at single life annuities, or SLAs as we call those. And you'll notice there's only 1 column here, 1 column labeled payable to you. And you might also notice, well, these dollar amounts are much higher. I like these. These are bigger. How come they're larger? Well, there's only 1 column. It's only payable for 1 person's lifetime. And the highest amount you see here in this example is $1,551, and that represents really a straight single life annuity. Keeping in mind there's none of these 6 options that you could elect in which the benefit, the monthly income, stops for the retired clergy. So you'll never reach a point in time when you say, next month, next birthday, next year, my benefit stops. But under the other 2 rows, the 5-year certain and 10-year certain, the benefit might stop for someone else. And I'll give you 2 examples. Let's first look at the one in the middle. The annuity type is described as life with 5-year certain or life with 5-year guarantee. You'll see the amount payable to you goes down slightly. Not a lot, but it goes down. in this example, to 1,540. So if a clergy person picks that 5-year guarantee and they live, for example, 23 years in retirement, well, that's great. It continued for the 23 years. They pass away. The 5-year term is long up. The benefit stops. Let's also look at the 10-year term, 10-year certain, 10-year guarantee. You'll see the amount payable to you again decreases, but the guaranteed portion goes up to 10 years. So let's say you had a single clergy person, and at the time of their retirement, they're not in good health. They have a particular disease, ailment, condition, and they say, you know what, I want to guarantee that payments are going to be made. We don't know how long our lifetime is going to be, but under that 10-year guarantee, payments are going to be made to someone. So if a clergy person were to elect that, they initially would receive, in this example, 1,501, and let's say they pass away after 7 years in retirement. The 10-year guaranteed term is not up. Whoever they have designated will receive those payments for the additional 3 years. And a question that often comes up, Ron, is that, well, what if that person dies before me that I've elected to receive the benefit? You would designate someone else. Guarantee means guarantee. If that person that you had elected began to receive payments and died before the term is up, they would have designated a beneficiary as well. Guarantee really means guarantee. So you see, you have a lot to think about. I'll just go back to the 3 joint and survivor annuity options. These are really the standard form of payment for a married clergy person at retirement. The single life annuities are an optional form of payment for a married clergy person, really the standard form of payment for a single clergy person. If you are married and for financial reasons decide not to provide a survivor benefit, your spouse needs to know about that and understand, agree, and consent, waiving their right to receive such a benefit and have that form notarized. So it's an important decision. I know everyone's financial circumstance is different. So you have 6 annuity options to choose from, and you would only pick one. Benefit access only allows you to pick one, to choose one option.
You know, Bob, I joke sometimes that as a married man, I am smart and that I would get my wife's permission to waive right. And we kind of make a joke out of it, but it's actually a point because a married clergy can pick one of the 3 single life annuity options if that makes more financial sense. Maybe that spouse has full benefits in his or her own name, and they'd rather have $1,500 or so instead of $1,200 or $1,100.
Absolutely right, Peter. A spouse could have, significant retirement benefits coming to them, potential inheritance, a large savings account. So there's many different considerations, including the health of the participant and the health of the contingent annuitant or spouse in most cases. The second important decision has to do with the cost of living adjustment, and this is a good feature. I think we all know that $1,000 a month of income today in 2019 is not the same as $1,000 a month 5, 10, 15 years down the road. These cost of living adjustments are a percentage of an annual increase in your benefit. When you go into benefit access, you're going to see the default will be pre-populated, which is a 2% COLA for both ministerial pension plan and the clergy retirement security program. But you'll also see that you can make changes with the drop-down menu, and it might be something that's interesting to do. See what the impact of a higher COLA would be. Look at the numbers change automatically on benefit access. What I'd like to point out is 2 different COLAs here. You can see where the 2% tracks, that's in pink, and that's a 2% annual compounded increase in your benefit. But let's look at the extremes. You might be thinking, well, why wouldn't I just want to pick the 5% increase, Bob? That sounds like a nice, big increase every year going forward. That would be the orange line on the bottom. A 5% COLA increase is significant. And what that means is right out of the gate, right out of your benefit commencement date, July 1, you will be receiving the lowest possible benefit, but it will be increasing every year by 5%. And after a certain amount of years, you'll actually end up receiving, with longevity, the highest monthly benefit. What about with MPP? You also have a 0% COLA option. and that is tracked in red on this graph. And with the 0% MPP COLA, you will get a significantly higher benefit right out of the gate from your benefit commencement date, July 1. But look at how flat that red line plots on this graph. No increase. So you start out with a very higher benefit, but at some point in time, you'll actually be receiving the lowest possible benefit. Some clergy might use this as a bridge until when they can receive Social Security benefits or receive other sources of income or inheritance or other assets. So it is a tough choice to make. Obviously, inflation is an important consideration with these COLAs. Historically, over long periods of time, inflation has tracked at just under 2%. So two real important decisions to make. And this is what it looks like on benefit access. And we have the red arrow and COLA pointing to that drop-down menu where you can indicate and look at what the impact on those monthly amounts will be with different COLA elections. So to sum up MPP, certainly a lot to think about. The first choice you have with the ministerial pension plan is to do nothing. You might not need this money right away, and you can wait. And you can wait up until the age of 70 and a half when you are required to commence ministerial pension plan. So if you're retiring at normal retirement, that could go on for several years. The opposite might be true. You might need this money right away. You might need this as a source of income to help replace the paycheck that goes away. So then you would need to make decisions in terms of not just the annuity option. Do you want a joint and survivor? Are you going to consider a single life annuity? What is your marital status? What is the health conditions of you and your contingent annuitant? And what do you want to do with that 35% of your account balance that is not annuitized? Again, the most common option I see is that it's easy to roll it directly over into UMPIP, and then you can receive this if needed, and maybe you don't need it, in installments on a monthly basis. You can tell Wespath how much you want those installments to be. You have flexibility. You can make changes going forward. You can take this in a full or partial lump sum distribution, depending upon your financial circumstances.
Bob, we did have one question that came up for a ministerial pension plan. So if the clergy person passes away, does that life annuity continue on for that surviving spouse?
Could you repeat the question, Peter?
So if with the ministerial pension plan, there's a life annuity. If the clergy person passes away first and they've designated a contingent annuitant, how long does that contingent annuitant have that lifetime benefit?
Excellent question. Yeah, the real important advantage of, and this pertains both to CRSP defined benefit as well as that 65% that's annuitized from MPP. These plans are valuable because they do provide not just the participant with a lifetime benefit, but also, if elected, one of those joint and survivor annuities, a lifetime benefit for the surviving spouse. Now, the only option that a clergy could choose that it might not continue for the lifetime of the spouse would be those 5- and 10-year guarantees that we looked at. If the clergy person doesn't outlive that term, it's only going to be for the remainder of the term. But under those joint survivor options, it really is lasting two people's lifetime, and that's what makes it so important.
Great.
A lifetime source of income.
Thank you, Bob.
Now you can see on our chart that the white arrow has pointed to the Minister's Reserve Pension Fund that we now call the Pre-82 plan. It certainly wasn't called the Pre-82 plan at the time, but that existed prior to MPP. And what makes this plan interesting is that each annual conference makes the decisions. They set the decisions for the retired clergy person. At Wespath, for most, but not all, annual conferences, we will calculate the benefit two different ways. We'll look at the defined benefit service money. We call that DBSM. We'll calculate that. We'll annuitize the balance, come up with a monthly amount, and we'll hold that number. Then we'll also go through the formula benefit, which is similar to what Ron had talked about with CRSP, math, something multiplied by something else to come up with an annual amount divided by 12. So in this example that we have, we'll look at the two different calculations. Please know that Wespath will always give the retired clergy person the highest of the two calculations. We won't call you up and ask which one you want. We'll just automatically send you the higher one. So in this example, we have a clergy person who has 6 years under the pre-82 plan. Just follow the example in the blue box. This particular example conference has a past service rate of $640 per year. And this is something you might recall is voted on at each annual conference. Often we see increases in those PSRs, those past service rates. So when we multiply 6 times 640, we get an annual amount, and then we'll just divide it by 12 to come up with a monthly benefit. So for the formula benefit, it is going to be $320, and then we'll also do the conversion of that DBSM balance, come up with an annual amount divided by 12. And in this example, we have 369. So at Wespath, we have 369 and 320. We'll automatically send you the 369. But we will continue to do the calculation every year because a point in time could be reached if an annual conference keeps raising that past service rate where the formula benefit is greater than the defined benefit service money converted to an annuity. We would notify you of that occurrence and flip you over to the higher benefit at that time. Now, Peter, I had mentioned that each annual conference makes the decision, so there's not a lot of choices here. If a clergy person is single at the time of their retirement, it is going to be a straight SLA, single life annuity, lasting the lifetime of that retired participant. Even if their marital status were to change in retirement, it would continue as a single life annuity. For a married participant, it's going to be a joint and survivor annuity, a lifetime benefit, and then a percentage continuing to the surviving spouse. Now, if you notice here, I have several different percentages. Depending upon what annual conference you are with, would depend upon what percentage the surviving spouse would receive. So best to check with your annual conference on this. But these are the examples that we have. Some conferences have a life and 70%. Some go with life and 75%. Others will go with life and 85% to the surviving spouse. And still others will go with life and 100%, continuing to the surviving spouse. Again, set by the annual conference. And it is the spouse during your Episcopal appointment at the time of your retirement that would receive these survivor benefits. Well, we have covered a lot of information, Ron. We've walked through the Clergy Retirement Security Program, and you explained the two different calculations for service, which was excellent. We also looked at that defined contribution with that flexibility and control. And certainly, I think the focus for the retired clergy this July 1 would be on those important lifetime decisions.
Right.
And we went into the pre-82 plan, and we saw how those decisions were set by each annual conference. And now we're going to talk about that, what's in that green circle, as some participants call it, UMPIP, United Methodist Personal Investment Plan. And with me is our benefit educator, Todd Creviston, and he's going to walk you through that UMPIP plan and explain what the important decisions are. Thank you, Todd.
Thank you, Bob. Hello, everyone. Here are the 4 ways that you can contribute to your UMPIP account. Before tax, after tax, Roth, and a rollover. So before tax contributions are taken out before your taxes are paid. So this decreases the amount of taxes that you pay each year. When you retire and take a distribution, you'll pay taxes on the earnings and the contributions. It's important to note that your before tax contributions, the earnings grow tax-free until that distribution and retirement takes place. After tax contributions means that you've paid your state, federal, Social Security tax. You'll pay taxes on your earnings when you take a distribution in retirement, but you won't have taxes on those contributions because you've already paid taxes on those when you put them in your UMPIP account. Don't worry about those intricacies. Wespath will take the lead on keeping track of that for you. You'll actually have a line item for each of these types of contributions on your quarterly statement that you can look at. A Roth contribution is a form of after-tax contribution, and with Roth, you may avoid paying taxes on withdrawals if you meet certain criteria. So your options for distribution as a retired participant, you can leave it on account until RMD. Wespath will help keep track of that date for you. I have a slide a little bit later that explains the definition of that. If you don't need the money right away, it will remain invested with Wespath. You have a number of distribution options. One is to take a full lump sum. Bob had mentioned there's some tax implications there. That'd be a great conversation to have with EY. You could take a partial lump sum, or you can take a cash installment, maybe monthly. You can self-manage, which means you determine how much you would like to take out of your cash account every month. You can also elect to enroll in life stage retirement income. And Ronald actually has an explanation of what that really is. Essentially, it puts your account distribution on autopilot, and he'll provide more information on that. Any remaining balances at the time of passing will be distributed to your beneficiaries. The idea here is that you have flexibility with your distributions. So at the time of distribution, Wespath will withhold federal tax for you. This isn't a penalty. This is actually basically a prepayment of your federal income tax. So for a partial or a full distribution, we'll withhold 20%. For a required minimum distribution, RMD, the amount is 10%. And that amount is paid to the IRS for you. When you file your taxes, you could end up getting a credit based on what was already paid. So required minimum distribution, that top sentence is actually taken from publication 590. It's rather complex. Again, Wespath helps you keep track of that. The penalty for not taking your required minimum distribution is very steep. It's 50%. Nobody wants that, and we help you keep track of that. But your RMD is required beginning no later than April 1st of the following year after the participant turns 70 and a half. So definitely we help you keep track of that. This will apply to all the defined contribution accounts, all the cash balance accounts, UMPIP, CRISP, CRSP, and MPP, that 35%. Your subsequent RMDs will be taken each calendar year using the prior year December 31 balances. And I would recommend, if you have difficulty sleeping at night, to pull up IRS publication 590. In addition to more information around your required minimum distribution requirements, there's a lot more tax implications there. When I read that, I definitely head off to sleep and have a great night's sleep. Here are the top 7 reasons to keep your money with Wespath. The top 2 would be the autopilot solution. So Life Stage Investment Management, that manages your account contributions on autopilot. The Life Stage Retirement Income manages the distributions of those. It basically places that on autopilot. EY Financial Planning Services is very valuable. This is available to everyone who has a balance with Wespath, whether they're active clergy or in retirement. So that's invaluable. There's also low expense ratios, and something that we added a couple of years ago is the ability for retirees to take a loan from their cash balance accounts. So that's instead of a taxable distribution. That is a very worthwhile conversation to have with the EY Financial Services. They can help understand what that looks like for you. You might be able to do that as a down payment for your house versus taking a larger distribution and being taxed on that. So now I will pass it over to Ronald Theodore to provide a little bit more information about the Solution Suite, Life Stage Solution Suite.
Thank you, Todd. Hi, folks. So Life Stage Solution Suite is a section that covers two components that we have within Life Stage. First, it is the Life Stage Retirement Income, which deals with retirement income that or money that you would receive in retirement through this service. And then we'll talk about the Life Stage Investment Management piece. Bob will discuss how your funds will be managed through retirement. Life Stage Retirement Income is a retirement income tool that is made up of your defined contribution account balances. So that is the 35% of the ministerial pension plan, the clergy retirement security program defined contribution piece, as well as the United Methodist personal investment plan. These account balances can make up a Life Stage retirement income monthly payment. This payment is a payment that is provided to you, to which it would adjust annually for inflation. You can keep these payments, you can opt in and out of this service at any point to where you'd receive this monthly payment. These payments are held within a payment safety zone, which allows a participant to receive a projected payment. If the account, once the account is reviewed in November, and if it is determined that you could receive an increase to a benefit, you would never go outside of the higher of the payment safety zone. And if through the review, the account is determined that it didn't perform too well and that you could receive a decrease, you would never go below the payment safety zone that would be illustrated here. So for example, a participant receives $827. They'd never go below $608 if they were to receive a decrease based on the review of that account. Or if they were to receive an increase, they'd never go above $1,237. Life Stage Retirement Income tool is, like I stated, a way for a participant to put their funds on autopilot. And all of these funds would be made up of the 35% MPP rollover, the CRSP defined contribution, as well as the United Methodist personal investment plan. There are other options available through this Life Stage Retirement Income account balance, and all that information can be accessed through our retirement team as well as online through benefitsaccess.org. Now I'm going to hand it over to Bob to where he will discuss investing with Wespath through Life Stage Investment Management.
Thank you, Ron. Throughout your active ministry, your money has been invested usually in three ways. Many of our clergy have utilized Life Stage Investment Management to set their accounts on autopilot, really to relieve them of that burden of self-managing their own accounts. Others have chosen to self-manage their own account, and that means they were choosing their own investments, coming up with their own asset allocation, and then readjusting or rebalancing that from time to time. They have identified their financial goals and really matched it up with the goals of our investment funds. Still others have consulted with EY on an asset allocation strategy, perhaps taking into account outside investments or previous accounts that they have. Life Stage Investment Management will continue to be available to our retired participants, still setting their accounts on autopilot, and it's very unique for each participant. Throughout your ministry, we based your allocations on age, when your benefit commencement date was, what was your risk tolerance and eligibility for Social Security benefits, as well as other Wespath plans. This can continue into your retirement. Many of you have completed profiles over the years, and on those profiles, you've indicated risk tolerance, age, eligibility. This is an example of an asset allocation for someone during their active ministry, and really an important feature of life stage is this rebalancing feature. It'll automatically make adjustments to your account balances when there's a certain amount of drift from those initial target allocations. So those two life stage suites of services, solutions are real important for clergy. One managing their money and the other, as you described, Ron, how they can really convert those consolidated DC balances to a lifetime of income. And that's an important feature because, you know, the tendency with defined contribution account balance type plans is, and what life stage retirement income is trying to do is counter the tendency maybe to take it out too fast or maybe to take it out too slow, but more to take it out just right. So we're going to move forward now. We're doing real good with time, and we're going to talk about the housing allowance exclusion. And this pertains to you in the retired relationship with the annual conference. And the best way to describe the housing allowance exclusion would be to tell you this is a tax break for retired clergy, not just our denomination of Methodist retired clergy, but other denominations take advantage of this as well. And we know very well, as you might as well, that this has been challenged in the courts over the years, and Wespath is in the fight with you and other denominations to make sure that this tax break for retired clergy continues. There's a little bit of work involved in determining what the housing allowance exclusion in retirement will be. Wespath will report how much income you receive from the various plans each year. And Peter, that's important because it doesn't matter where the money is coming from. If it was a pre-82 benefit or a CRSP benefit, maybe money coming from UMPIP, life stage retirement income. Each year at annual conference, there is a vote, and usually that vote is, well, 100% of what comes out of Wespath is allowed to be excluded from taxation. Doesn't mean it will be, but it's allowed to be. But you really need to look at three different considerations to calculate what this allowance will be. The first one is, what is the amount designated as a housing allowance by the annual conference? Wespath will report the amount that you receive from us. So let's say, for example, a retired clergy person is receiving $2,000 a month from Wespath. That number will be reported to you. We do have a worksheet that's available on our website and by calling our service center, and it's a good starting point. EY also has a terrific worksheet that can be used. The retired clergy person really needs to make a bona fide attempt to calculate money that's expended on housing. And oftentimes I'm asked, what does that mean, housing? Well, it's your primary residence. So that could be, a single family home, a lake house, a condo, a co-op. Maybe you're renting an apartment. Maybe you're renting a home. Whatever your primary residence is, there's going to be expenses involved with that. So the second consideration is, what was the amount actually expended on housing? And some of these subcategories would include things like rent payments, mortgage principal payments, mortgage interest payments, real estate property taxes, maintenance expenses, what utilities for that primary residence, furnishings, and any other applicable expenses related to that housing would total up and be the second consideration. So you have the amount reported from Wespath, the actual amount expended. Now we need to look at the third bullet. What is the fair rental value of that housing? And there's different ways to determine that. Some retired participants have told me they've used websites like Zillow, which has been helpful to determine that. Still other retired participants have told me what's been very helpful is to enlist the help of a local real estate person, maybe someone they knew, even from their congregation, that could come over, look at that property, look at comparables in the area. And they did provide that retired clergy person with a letter stating that, we've looked at the property, we've looked at comparable rentals in the area, and this is what we think this could rent for on a monthly and an annual basis. I think that's real important to obtain something like that to support that third consideration. So once you have these three considerations, it's very easy to determine what the allowance would be. And I'm going to give you two examples of a housing allowance exclusion. And one is very straightforward, and the other is a little bit more interesting and perhaps more realistic as an example for this housing allowance exclusion. So let's look together at this retired clergy person. The three different considerations are listed. The retired participant receives from Wespath $2,000 a month, and again, it doesn't matter from which of the plans that we discussed. That's the amount designated. That's $24,000. They've used their worksheet. They've made a good attempt to keep track of expenses in retirement related to housing, and that number came up to be $20,000. They worked with a local real estate agent and received a letter indicating that the property would rent for an annual basis of $21,000 with furnishings and utilities. So then you have the three numbers here. The work is done. You look at this and you determine which is the lowest of the three, which would be the amount spent on housing, the expenses. That would be $20,000. The exclusion cannot exceed $20,000. So what does this mean? The bottom line is that the amount taxable would be $4,000 of that amount received, the $24,000. So that's a real important tax break for retired clergy. Well worth keeping track of these expenses to take advantage of this important tax break. And the second example that we're going to look at compares two different retired clergy. And what's interesting about the example is that these two clergy were twins and they did everything identical throughout their life, including retiring on the same date, the same season, the same amount of income on a monthly basis received from Wespath, $1,800 per month for both of them. And they both purchased identical houses in the same town, for the same price. But what they do that's different in this example, clergy example A goes to a seminar and hears that there's different options available, and they decide to take out a partial distribution of $40,000 as a down payment. Now, clergy twin B says, well, there's other options available. Todd had mentioned that very important retiree loan program where you can borrow, which is not considered a distribution. Perhaps you could consider financing from a mortgage or bank. But the bottom line is that Reverend example B didn't have any of the income from Wespath subject to taxation. Reverend example A, because of that $40,000 one-time distribution, had a much greater amount subject to taxation, an amount of $37,600. So really, what the story tells us is that there's different ways, and we've talked to EY, and we know that's a very common consultation topic for clergy. Maybe you're leaving a parsonage after many years, maybe buying a home for the first time. EY can help you calculate, well, how much can you reasonably afford on housing costs and retirement, and help you come up with the best solution for perhaps that down payment on that housing. Real important tax break. This is the worksheet that is available by calling or on Wespath's website, which is a good starting point to calculate this housing allowance exclusion. This is available to the retired clergy person. It does not continue to the surviving spouse. Unless that spouse happens to be clergy, a clergy couple, then it would continue. And we suggest that you attach a note to your tax form, whether you file electronically or not. You attach a note, and the note would say, in effect, I received $24,000 from Wespath, the United Methodist Church Benefit Board, last year, and I did not, as reported on the attached 1099-Rs, and I did not include, $20,000 of this amount because it is allowed to be excluded under Section 107 of the Internal Revenue Code as a housing allowance exclusion. Words to the effect, furthermore, as a retired United Methodist Church clergy person, I'm entitled to take this exclusion. Thank you. That note can be found right on the back of your housing allowance exclusion worksheet. And for additional information, you can refer to the section in your annual conferences journal. So real important tax break for retired clergy. Now we're moving along, and I'm going to turn it back over to Ron Theodore, and he's going to go into a little bit about the death benefit under the Comprehensive Protection Plan. Thank you, Ron.
Thank you, Bob. So the Comprehensive Protection Plan, this is the death and disability plan that is available for participants. But as a retired clergy participant, there is a retired death benefit eligibility. This benefit eligibility consists of one of two of the following: a participant serving 25 years total CPP participation, or CPP participation immediately preceding retirement and last 12 of the 15 years. If you are a clergy who is not quite certain on whether or not you are eligible, you would be eligible for this death benefit as a retiree, you can call our customer service department at Wespath, and one of the customer service department representatives would be able to assist you, as well as you can call the retirement team, and the retirement team would be able to get confirmation on whether or not you are eligible for this benefit. And that the benefit amount for a retired clergy, the death benefit amount would be $20,400 for a clergy who were to pass away to their beneficiaries. And if a clergy's spouse were to pass away, then $15,300 would be available to that clergy for their spouse passing away. All of your beneficiary designation can be completed one of two ways. Again, by logging on to benefitsaccess.org, you can update beneficiary designations, or you can call our customer service department and request a designation beneficiary form, and you can update your beneficiary election on that form as well. Now I'm going to hand it over to Todd, and he can talk about EY Financial Planning Services.
Thanks, Ronald. So EY is available to all clergy, to everyone who has a balance with Wespath. It's confidential professional financial counseling at no additional cost. Wespath has had a 12-year relationship with EY. They used to be known as Ernst & Young. They've changed their name to EY. It's objective advice. There's no sales pitch. They are well-versed in all of the options that you're thinking about regarding your defined benefit account, regarding your defined contribution accounts. They are well-versed in all of that, as well as the clergy housing allowance or exclusion. So there's no need to enroll. You can begin that process by calling that 800 number, or you would go to that website and create a username and password to begin. There is also a lot of information available online, whether it's a webinar or an article or other information that you're able to read and use. So it's definitely a wonderful resource. We would love for everybody to use that. So now, at this point in the presentation, you're probably thinking, when will my first direct deposit begin? And then the second would be, when is the subsequent direct deposits? So the first payment will take place on July 3rd. This is because it takes an extra day or two to annuitize the millions of dollars for the current retiree class, and but it will be there as a direct deposit on the July 3rd. Subsequent cash payment or subsequent payments, the life benefits will be made on the first day of each month, and the cash installment payments will be made on the second or third business day of each month. And now just a real quick review of benefits access. You can get there by wespath.org or just going to benefitsaccess.org and log in. As Ronald said, this is where you will make all of your elections, your retirement elections. So you have until June 28th. However, please don't wait until June 28th. Should there be a power outage or a Wi-Fi outage, we would hate to have your retirement benefits delayed. Also in Benefit Access, you're able to update your beneficiary designations, either add or change their address. Children tend to move, so it'd be great to keep that up to date. A ton of educational resources and your current account information. And now I'll quickly pass it over to Ronald, and he will introduce to you the retirement team.
Thanks, Todd. Hello, folks. So as you all can see, this is a photo of what used to be completed retirement team, but as of changes last year, I actually left along with 2 other colleagues, but there are 4 individuals on the retirement team that are dedicated to assisting all of you current year retirees. I kind of refer to them as the concierge through the retirement process. So I would definitely encourage you all to write the number down that you see here, the 800-883-4078 number. That is the retirement team direct line, and to where you will speak to one of the 4 young ladies that are on the retirement team currently. And they are dedicated to assisting you all through this time. I kind of refer to them in the anxiety relief business, as they are there to answer all of your questions and help you through this process. At this time, I want to take the time to congratulate you all on your retirement and thank you for your dedicated service to all of us here at Wespath, as well as those within your communities. Thank you all, and congratulations.
Thank you as well.
Thank you.
God bless. Thank you for participating in your service.